Hey guys, welcome again. So today we want to talk about EURUSD and what transpired in the market today. First of all, I'd like to give thanks to Michael because if it wasn't for him, I wouldn't be able to understand the market in much more detail as to how I've been able to penetrate thanks to his content, his free YouTube content, as well as what he posts on Twitter. So Michael, thank you very much. Um, so our point of reference, as I've said, will be on EURUSD. Um, I normally love, I normally love to trade the pound dollar currency, but of late the market has been very choppy and volatile when it comes to GBP USD. So I decided to, look at Euro USD since it normally complements with how the market moves when it comes to uh, if GBP USD is not corresponding well with how we would want or in terms of entries and strategies, but you can look at the Euro USD and chances are it may correlate very well with DXY. So first things first, I was able to identify sell side liquidity, um, as you can see here. So just label this one. Sell side liquidity, right? So the next thing is to identify a break in market structure, right? So what I normally use or what I normally gauge in terms of identifying a break in market structure is normally the last significant lower high if the previous trend was a bearish trend. So like for here, I was able to identify this key level at 0.96715 as the break in market structure level target. So what I do is just take a trend line and be able to, extend it on my right up to that point. So can um, classify that as break in market structure. And look what happened, guys. As the market was rallying up and targeting liquidity, there was buy stops residing on top of here. Once that happens, market took out that level. Once it took out that level, went and created a new high. And what happens when it comes to the direction of the market always goes to level of liquidity. And now, aside from targeting highs and lows, ICT also spells it out for us that the fair value gaps and the gaps in the market are also a very key determinant in terms of fair value gaps. So once the market was able to penetrate this level and looking for a reversal down to a significant fair value gap, this is how I was able to identify it. So as you can see, the market had 1, 2, and 3 levels as potential fair value gaps. So according to Michael, he normally advises us to go for the low hanging fruit because you'll be able to diversify your risk and as well as your stop loss. Your stop loss will have been much more tighter if you were to enter on this lower fair value gap as compared to this first fair value gap. So what I did, I was able to highlight this region, right? I was able to highlight this region and as my potential target area, right? So if I can just correct this one. So basing on the trades, you can enter on top or below or even the 50% of the fair value gap. I normally like to enter at the 50% of the fair value gap. I base my entries on that. So what happened on this particular scenario, if I was to enter on the 50%, this would have been this was my case scenario. but I only targeted up to about 58 pips. By the time I wanted to extend my target, the market had already taken me out in terms of profit. It had already hit my profit before I could even adjust my TP, and that's okay. You don't have to get everything in the market. So long as what you've been able to attain is there, and that's fine. So my stop loss was just below this low, and this is how will this is how the market went. So if you were to enter on this particular trade, you would have identified this significant high here, as your potential um, ATP, right? What has happened, what has transpired in this particular region is exactly what transpired here. Because as the market was rallying up, it your first target will have been this high, all right? So once this high was taken out, you would have modified your trade and started scaling your profit, in the sense that if your lot size was one standard lot, you will have modified and closed about 0.9 uh, of your lot size and leave about 0.1 to run in the market, and that will be able to give you or be able to diversify your risk, close your profits, or yes, close your profit, and and let your other level run in the market. So as you can see, this is how it looks like on the 1 hour. So basing on the minute 15, um, this was a classic scenario of a market maker buy model. According to what ICT normally uh, outlines, right? So there's a level of consolidation that you can frame it for. Those three significant boxes before we get to that last one. All right. So once that consolidation level has been broken, this is just a sketch, not ideally the correct thing with how the market moves. Just giving you a rough estimation or a rough outlook of how the market maker buy model will have looked like. So if there's supposed to be three, you say there are normally three case scenarios. So you can just extend this one here. Yeah. This case scenario, so we can change the color of the field here. We can give it a blue color. Give it a blue color. Increase the affinity to here. This one we can change it to that one, as now the market is going up, and this is typically what ICT states in terms of IPDA, right? The consolidation movement. After that, we get the expansion. After that, we get reversal or a retracement. All these things, right? So from here, there's something that ICT normally states in terms of SMT. If like on this particular region, there was a lower low that was formed, and then now the market formed a new higher low. It didn't form a lower low. So this was a classic SMT, right? And after that, now this is one of the parameters that you will have used in terms of entering the trade. And also, if you look at the time sessions, if you look at the time sessions, it was also critical because this movement happened during the London session. So yeah, this one's out. So this movement happened during the London kill zone. Sorry, if it's East African time, that's 9 to 12 noon, right? So that's the London session, and you see this particular move happened during this London kill zone. Sorry, so if you were to be able to identify using the SMT, and you would have based your entry on that, all right? And if you were to use another criteria, for example, if you were to use another criteria, let's drop let's drop to a much more lower time frame in terms of getting an entry, right? This same particular region, right? If you were to look for an entry, if it's, let's say, sell side liquidity, you're targeting, a break of market structure. After that, you look for a fair value gap, that fair value gap to be hit, and then the market gives you an entry. So minute 15, the entry was not there. If you can drop a bit lower to minute 3, try to see if we had something there going on. Still the same case, no clear area of fair value gap that was clearly seen, right? So if you were to drop to the last available candlestick level, that is minute 1, and we want to base on during the London kill zone, right? So if you are basing it using the London kill zone, I'm looking for a structural shift, right? So we would have identified quite a significant level, depending with your stop loss, where it would have presented itself. That would have also been a very key critical area. Now on this particular time frame, this is what can be seen, right? This is what can be seen. So this can be potentially sell side liquidity. This can be potential sell side liquidity, and this particular region can be a potential breaking market structure. So that goes there, right? So the market went past this key high, and now you're looking for a fair value gap that presented itself as we're basing an entry. So if we were to highlight this fair value gap, this will have been potential area. Right. So if you want to enter, if you were sorry to enter on this particular scenario, this will have been your entry, right? So if you were to use a stop loss, for example, up to this low, that's about 12 pips. So depending with your risk to reward ratio, if you someone that normally uses 15 pips or 20 pips or 30 pips, you will have gotten your stop loss above that level, or below that level, as you're scaling up your profits and how the market rallied along the way, just now depending with where you were targeting. So this was a classic ICT setup, and I'm really happy. I'm really glad I was able to take. I was really able to get this move. Um, got me some significant amount of pips. Um, that was really really awesome. As you can see from this chart, I got I got in from this February gap that was there, and this was my entry. Right, I used one standard lot size, and the market was able to get me in as the price move. As I was telling you, my level was here, my target profit was here. By the time I wanted to adjust it, the market had already, taken out my TP. So, um, if it's terms of scaling profits, and this is how I was able to make today. So, thank you very much, guys. As Michael always say, I wish you good luck and good trading.